Mike, I'm turning it over to you. Bold prediction for 2024. We got rates in the fives. Where do you see these rates going? What's going on?
Yeah, so I think that a bold prediction of saying that rates could be in the low to mid fives, even as early as mid-spring to middle of next year, is not as bold as it seems. And just for you guys, I did a ton of research into this, and I ran regression analyses and compiled 52 years worth of data. So this is not just some crazy bold prediction that is just coming out of nowhere. So let me take a slight deep dive into some of these numbers that I found. So I charted out the difference, and this to me was an important differentiator because a lot of people will look at the 10-year treasury yield as an indicator of the mortgage rates. But why? What is the difference between the mortgage rate and the 10-year treasury? How does that change? So I looked into that. So obviously there's always going to be a spread from what we've seen between the 10-year treasury and the mortgage interest rate. But recently that spread has been much greater than it has been in years past. And so what we've had historically over the last 52 years is an average spread between the 10-year treasury yield and the mortgage interest rate of 1.73. Okay, so that's just the 52-year average. There's a lot of high outliers. There's a couple of slight low outliers. But right now, as of November of 2023, that's the last data point that I was able to pull, our spread between the mortgage interest rate and the 10-year treasury is 2.94. And so we've got a much larger than average spread between the two. And a lot of that, if you read up on it, is considered to be fear over the inflation rate. So, yes, I know what you're thinking. Did I look into that? I did. So I ran a regression analysis to see the effect size of the inflation rate on the spread between the mortgage interest rate and the 10-year treasury. And interestingly enough, it is technically significant, but there's a very small effect size. So there's a lot of math language that I'm starting to use here. But basically what I was able to find is that over the last 52 years, the change in the inflation rate of 1% only makes a 0.2%, 0.2 impact on the spread between the mortgage rate and the 10-year treasury. Now, I've been a little bit wordy. What does that mean? Basically, what it means, to sum it up, is that there is way too far of a spread right now between the 10-year treasury and the mortgage interest rate. It's much higher than normal, and we're due for a regression to the mean. So
just real quick, Mike, historically, how big of an outliner is this? Like this spread that we see right now, has it happened before? How frequently? Just how far off are we?
So interestingly, yeah. So right now we're sitting about 1.21 above where it should be. The 50-year historical average is 1.73. Now, what's interesting is, again, when I looked at the effect size of the difference between the inflation rate and that difference, it's pretty small. And the last 3 times that we've seen this, as some people might imagine, have been currently. We saw it in 2008, 2009, and I think some people know what happened then. And then we saw it in 2000, 2001, which was the dot-com bubble. So what it seems to be, and I don't have enough data to prove fear, but it seems to be fear tied into the changes in the inflation rate and the changes in the economy rather than actual changes in inflation itself. And the longest sustained periods that we've seen of the spread being greater than 2 for at least 10 of the last 12 months were in 2008, 2009, and 2000, 2001, and none of them lasted longer than 2 years. Well, February 1st of 2024 will be 2 years of us having a greater than 2 spread between the mortgage rate and the 10-year treasury. So what does that mean? That means that if we hit our predictions, as of today, we're at about 3.9 on the 10-year treasury yield. The predictions are that we'll be somewhere around 3.4, 3.5 by March, April of this coming year. If we regress closer to our mean, that means that you add 1.73 on top of that, and you're in the low fives. Now, will we fully regress completely to that mean of 1.73? I don't know about that. We're, a little bit high right now, being near 3, but I do see not just some kind of easing of the 10-year treasury yield, but easing of that spread between the 10-year treasury yield and the mortgage rate And that, along with the easing of the 10-year treasury, should get us to that mid fives mark by April, May, maybe even March.
So, Mike, ton of great information, and I think I speak for both Mark and I when I say thank you for being more prepared for our podcast than either of us are, because that was a lot there that in a short period of time. This all sounds great. How does this not happen? Like, what are some of the things taking the other side of the argument where, hey, rates don't get into the fives, and here's why.
So it would take a bit of a historical anomaly, because when I looked at the data, there's only one other sustained period that was as long as what we're currently seeing. And that was 1981 to 1983. And the difference between the 10-year treasury and the mortgage interest rate was very similar back then, but the interest rates were 13, 14%. So the percentage difference, as a factor of what the actual interest rate and 10-year treasury was much smaller. So what we're seeing is historically anomalous. Now, that doesn't mean that, we can't continue to see an anomaly that just continues forward. There's even over the 52-year history of looking at this stuff and recording all of this data as a country, that's still a very small sample size in the history of, world economics. So I could see there being an outlier that has never happened, but in the history of recording this, that has never happened. So there would have to be some sort of, factor that we're not seeing. Nobody saw COVID coming. Nobody saw, a lot of the things that have happened. There were only a few people that saw the housing crash coming in 2008, 2009. So it would take some sort of outside factor that we're not seeing. Otherwise, we're kind of mathematically due to regress.
Whether you follow politics or not, I think that's going to come into play this year as well too, because I think historically in these election years, whoever is the city, if there's an incumbent, they're always trying to maintain control of the economy in a positive way to promote their reelection. So I feel that's on the side of what you're stating as well too, that could benefit it.
Yeah, and it'll be interesting because the Fed has been so down the middle in recent years, and I will be very curious to see if, I think there are going to be, updates to the federal funds rate. I think they are going to start easing them a little bit based on the language that they've been using in recent meetings. And I think people will probably tie that into politics. Now, years past, it may have happened for political reasons. I think we're going to see a little bit of correlation that may not be, causal.